Hello everyone, welcome to this lecture on corporate finance. In this session, we will understand the basic principle, objective and decision that derive financial management in the companies. Okay, before we begin, let me ask you something. Have you ever thought, how do companies decide where to invest money? How do they arrange money? And how do they manage their profits? So all these decisions are a part of corporate finance. Okay. In simple term, if I will say that corporate finance is about managing money in a business, and the success of any company depends on how well these financial decisions are made. Okay. So in this lecture, we will build a strong base that will help you to understand all future topics. Okay. Now let us start with the meaning of corporate finance. A corporate finance is the area of finance that deals with sources of fund, capital structure and decisions that increase the value of firm. Okay. In simple words, it focuses on the three main activities. First one is raising fund, second investing fund and third one is managing profits. Let me explain with a simple example. Think of yourself. Whenever you earn money, you have to decide, should I spend it, should I save it, or should I invest it? In the same way, a company also makes these decisions, but on a larger scale. Okay. Now let us understand the key components of corporate finance. The first one is sources of funding, that companies can raise money through equity, debt, and from both the sources. We can call it hybrid financing. Second one is capital structure. This refers to the mix of debt and equity. Now you may ask, why is this important? Because too much debt increase risk and too much equity may reduce the control. Okay, so company tries to find an optimal balance between the sources of fund, like the company want to raise equity or debt. So next is value creation. The ultimate goal is to increase the value of company, right? So that is why corporate finance focuses on maximizing shareholders value. Okay. Now let us understand the scope and importance of corporate finance. Why corporate finance matters. A corporate finance covers all the financial activity in a firm. It mainly includes the capital raising. This is about arranging funds, because without funds a company cannot operate or grow. Okay. Second one is investing decision. This involves where to invest the money. Like wrong investment means losses and right investment means growth of the company. And third one is our value creation, which focuses on increasing the company value. Correct? Good financial decision leads to long-term success. At this point, you might thinking, why is corporate finance so important? So the answer is because it directly affects the profitability, growth, and the survival of the company. Okay, without proper financial management, even a profitable company can fail, right? Next is the main objective of corporate finance. So what is the primary objective of corporate finance? That is wealth maximization. What does it mean? It means maximizing the present value of future cash flows. What does it mean? the maximization of the present value of future cash flows. Got it? If in a simple term, increasing the value of company over the time period. Okay. So there are the important concepts here, that is time value of money. A rupee today is more valuable than a rupee tomorrow. What does it mean? A rupee today is more valuable than a rupee in tomorrow, right? Why? Because it can be invested and earn returns, right? Second one is risk consideration. Every investment involve risk, correct? So higher risk, higher expected return. So these decisions must balance risk and return. Got it? One more is there, that it focuses on long term, right? Long term focus. Corporate finance focuses on the sustainable growth, not just short term profit but long term value creation. Got it? Now we compare the profit and wealth maximization. What is profit maximization? It focuses on the short term earnings. It ignores the time value. Also, it ignores the risk, correct? And wealth maximization, it focuses on long term value, consider the time value of money, also consider the risk. So at this point, you might ask, which is better? So the answer is wealth maximization is better. Why? Because it gives a more realistic and sustainable approach to the corporate finance. Next, we come to our the most important part of the corporate finance, that is corporate finance decisions. The three major financial decisions. Corporate finance revolves around all these three financing decisions. First one is investment decision. Second one is financing decision. Third one is dividend decision. Okay. So investment decision is where should the company invest its money. It includes, it can invest in any project, any machinery, in or expand for the expansion of business. Okay. This decision determine the future profitability of the business. Next one is financing decision. It shows how should the company raise fund. The company having the option like equity and debt. So the main goal of the financing decision is to minimize cost and risk. Third one is dividend decision. What should be done with the profits that the company earned? So the company having the options, pay the dividend or retain their earnings. So this affects the shareholders' satisfaction and growth. Correct? So these three decisions are interconnected. Like investment needs the fund, financing provide the fund, dividend distribute the profit. So together they determine the value of the firm. Okay, got it? So in this lecture, we have understood the meaning of corporate finance, scope and importance, wealth maximization, profit versus wealth maximization, and the three key decisions of corporate finance. Okay, so this form the foundation of corporate finance. So in this, so in the next lecture, we will move to our next topic, that is time value of money, which is very important concept in the corporate finance. So thank you and see you in the next lecture.